the wettest winter on record in the history of the state. Don't invest the money that you cannot afford to lose. Our mission is to partner with as many property owners as we can to help them.
Today we've got Eugene Gershman in matching sweaters if you're watching on YouTube.
Hello, that's right. Yeah, we definitely planned this.
Thanks for coming on the show, Eugene. If this is your first time here, listener, my name is Emma Powell. We talk about entrepreneurship, real estate, investing, and living a passive income lifestyle on this channel where I think there are just a lot of misunderstandings and misrepresentations and frankly a lot of BS in the passive income world where people think it's starting a business that later becomes hands off and you end up running just a business that you didn't realize it's going to be that hard. Or you buy a rental house thinking that's going to be passive and it's not. So, how do you actually get passive income? What does it take to get it? How much work does it take up front? Then, what does your lifestyle look like after you've achieved it? Because people talk a lot about, I don't want to retire early and lose my purpose. And this is not about scams or selling you something or losing our purpose in early retirement. It's just about talking to people and getting to know them. So today we're getting to know Eugene Gershman. He is from my hometown, Bellevue, Washington. I grew up in Kent. I graduated from Kentwood High School. I moved to Mercer Island as a nanny for some physicians right after high school, and I went to Bellevue Community College for a year and a half before leaving the area. So that's my old stomping ground. I get back there a lot to see some family as often as we're able to. And so thanks for coming on the show today.
Absolutely. Yeah. Thanks for having me. It's funny. I live like 3 blocks from Bellevue College. They no longer call themselves community college. They're just
Oh,
Bellevue College now.
they have like legit degrees now.
Yeah. They have a 4-year degree now.
Oh, really? Okay, I didn't even know that. So I ended up
Yep.
graduating from BYU later, but it was a great little start, nice little area. Like I said, we got married in Bellevue, learned how to drive in the area, and even ever since I was a little kid, we would be driving around and I would see these big signs and tractors, and they would be saying like coming soon. And it could be a gas station or a hotel or a new subdivision. But even when I was very young, I was very fascinated. And I would say, like, Mom, what are they building over there? And I used to learn how to I draw all these houses and forts and things like that. And I actually learned how to do computer art by drawing floor plans and different things like that. And so I've always been fascinated with this topic. So when you start talking about development, new construction, new development in the real estate world, from an investing standpoint and how people could get involved in it. That was very intriguing to me because when I've done development before, I've been managing partner. It's a lot of work. It's very risky. And I think that you have maybe some solutions that you can share with our listener on how everybody can evaluate and get involved in new development as a diversified part of their portfolio. So, kick us off with giving us a little bit about yourself, your background, how you got involved in this. I think development can be very sexy, but people just don't really know how to get into it. So, would love to hear your story there.
Oh, absolutely. Yeah, no, it's a big pain in the ass, but it's a fun industry. It's like the way I describe real estate development is it's like if you take all of your business schooling and you start from acquiring something, land in this case, then you put together a team of different engineers, architects, finance people, investors. So you're managing all of a sudden, even if it's just one person running the development company, you're hiring an army of different professionals who you have to manage. They all have their attitudes, they all have their ambitions, they all have their experiences. So you need to navigate that. You need to figure out how to get enough money to get it built. So now you're dealing with first investors with all of their risk profiles and what they know, what they don't know, what they're comfortable with. Then you need to take that to a bank or a lender and convince them that this is the right deal. And then when you think the hard part is done, now you have to build it. And that's when the fun starts because now you're dealing with contractors who have absolutely different attitudes and they think you're an idiot and they think you're made of money and they can just charge you whatever they want. And you have to watch them every step of the way. And then you figure out that as you're building, all of a sudden you realize that your designers forgot to specify a bunch of things. And now your contractors charging you extra money. So all of those things, that's a long winded answer to the question how I got into it. But real estate development is a combination of all these different trades. And the way I got started is my father owned a construction company and I never wanted to be a builder. I said, you know what, you do your thing. I'm going to do my thing. I want to make it on my own. So I went and got my degree in economics, started working at this investment firm, got bored, got my MBA. My last year of MBA, my dad calls me and says, quit screwing around. I need some. And so then I joined the family business. And 20 years later, we finally shut down the construction company and we're focusing 100% on development.
How does somebody make that leap? Because you mentioned contractors, their own breed. oftentimes do not share the same vision or KPIs that the developer is sharing. And everybody knows that example. Like the contractor who's working on a custom rebuild where the family's like, no expenses spared. This is what I want, right? Versus a contractor who can work with flippers on a budget, on time, and we're just trying to get it to be good enough to get back on the market. And those kind of competing priorities, and it's a different skill set. So tell me a little bit about how a contractor makes that leap into developer, because most of the large developers that I know actually are also large contractors.
That's an interesting thing. In our case, the way we got involved in development was almost by accident. The first project that I got involved in when I got done with my MBA, we partnered with another developer who owned the property, and they were fundraising, and we got introduced to them. We got offered to invest in their project, and also it was a way for us to expand our construction company and open a branch office in a new location. So that's what we did. And that was the first step in our development journey. We were still very much on the construction side of things at that time, and I was in charge of mostly financial operations for that branch office. But then when I started looking to evolve the company and grow my own little niche within this firm that my dad owned, I really didn't know how to get new construction gigs. I didn't know people. So we said, let's just buy a piece of land and build it out. And because we know how to build, we'll develop and we build. So that's how we essentially will buy a new project for ourselves. So we started doing that, but really the niche evolved, that partnership niche evolved for us. And now this is pretty much 100% what we do is we no longer buy properties that we would develop. Our mission is to partner with as many property owners as we can to help them realize their development ambitions. And you're right. It's a completely different way of looking at things. But I personally think that for the most successful project, you have to have these healthy conflicts of interest, conflicts, emotional human conflicts for the project to be successful. So you always have a conflict between a designer, an architect, engineer, and the owner. You always have a conflict between the owner and the contractor, and you always have a conflict between the architect and the contractor. And the reason you have a conflict, it's not necessarily that they're all fighting and suing each other, right?
Yeah.
It's not what I mean. I just mean that they have their own interests. When an architect designs something, they want something, the most beautiful thing out there, the most unique thing. They want to make a statement. They want their name to be engraved on that monument and exist there for centuries. And the contractor says, "Oh, great! I'm going to build this thing. It's going to cost $1 billion." And the owners, you guys are all full of crap. I'm never going to make money, so we have to figure out how to make it work. And it's a simplistic example, right? But that's how it really works, and that's why we like putting these things together to find that perfect balance. And so the challenge for companies that both for developers that also own their construction operations, and that's the challenge that we had, is that a contractor wants to make money from construction. They're typically making profit. They're marking up their cost of construction, right? It could be on the smaller jobs, it could be 15, 20%. On larger $100 million job, it could be 2 or 3% markup. But a contractor makes money by marking up the construction cost. So inherently, the contractor makes more money if the job costs more.
Yeah.
So their goal is to build it for as much money as possible. Now, if you ask the contractor, they'll tell you, "Oh no, we're interested in helping you and we want to build it for the most." Yeah, no. On paper, they make more money if it costs more. That's just how it works.
Yeah.
And so I forgot the question, but
Oh,
anyways.
that's that's okay. It's just a conversational style podcast. I always tell our listeners, like, imagine that you're at a networking event and you meet somebody that you think is interesting and you have an opportunity to stand there for an hour like I have. And I hate the term pick your brain, but really just pick your brain, right? And just that conversation flowing back and forth, the listener kind of learning alongside me in the conversation. So it goes where it goes and we'll see what happens. But you said something that actually really caught my interest because we often see conflict is bad, especially women. But if you read Five Dysfunctions of a Team, conflict avoidant is one of the profiles that I think I actually identify with that one the most. And so what you're talking about is like not having just a room full of yes men and people who are just agreeing with everything. Oh, the vision is beautiful, the cost is great, and there's no challenge there, so there's no really growth there. So how do you know when you're in that healthy amount of challenge? Because this could be applied to development, it could be applied to a marriage relationship, it really could go to anything. When is there a good amount of conflict where people are being creative and pushed to their limits to come up with good solutions versus when it becomes a problem? And I'll just give one quick example and then you can kind of tell me your thoughts there. Some of the apartment buildings that we invest in will have one of the general partners will own a construction company or commercial construction company. And I always used to see that as a good thing until we were in a deal where one of the commercial contractors wanted to actually bid the work. And it became a big problem because there was that conflict where the general partner wanted to get more money from change orders and taking too long and things like that. And it was really costing some problems on the investor side of things. And so eliminating those kind of conflicts of interest are important, but at the same time, it's like, how do you make sure not everybody's playing on the same page enough to get something done, but not so much that it's just an echo chamber?
I think the most important thing is always communication, right? You have to be able to communicate and discuss things on an ongoing basis. The challenge we had when I would own the development firm, where my goal is to build this thing for least amount of money and to sell it for most amount of money,
Mhm.
and also owning the construction company, is I would compensate my construction team based on the efficiency. And my construction director managed the construction job as a regular contractor would. So if there's a change, he would send me a change order. And I would pick up the phone and I'd be like, what the hell is up with this change order? I don't want to pay that. I'm like, what is going to happen in the end? Like, it's coming out of my pocket. And so I would know all the details of how they're operating. I would almost use that sometimes against the folks in my construction company. And so what would end up happening is there's a finite pot of money, and you have to decide, do you want this pot of money to go to the ownership group where it's going to get split up between all the investors, or do you want it to sit in the construction pot where ultimately it goes back to us? And I feel like if it's like this internal conflict of interest, it became almost unhealthy.
Mm.
Whereas if I was working with a third party construction company, that would stimulate me to prevent these
Oh.
situations from happening early on.
Mm.
Because
Okay.
when I own it, I'd be like, ah, whatever, don't worry about it. We'll figure it out as we'll go along. And it gets difficult. In this utopian scenario that I would like to see is that we cross all the T's, dot all the I's way before we get out in the field.
Mhm.
And that's where it becomes super important to work with contractors that have a tremendous amount of experience building that specific product. Not just the builder Bob buddy that you've known since you went to kindergarten,
Yeah.
because he's an honest guy and he's never going to screw you. But if he's never built that type of a project, an apartment building, townhomes, or I don't know, a warehouse, if they've only built custom homes, have only done remodels, then even though they might be the most honest person ever,
Mhm.
they don't know what they don't know. So it's super important to work with experienced team that knows exactly how to build this particular type of project, but
Mhm.
also that knows what questions to ask. If they don't know what questions to ask, you're going to get to the middle of your concrete pour to realize that, I don't know, something's missing.
Yeah, like expansion joints. I've heard that one before.
Right.
Have you found that there's a certain amount of control, either more or less, that you have over the construction project or the development process now that you have put construction into a different bucket and started working with vendors instead of doing that in-house?
Yes. And I think the most important part is a lot of times developers with less experience, a lot of like public development firms, they rely on this idea of we're going to get it designed, we're going to hire our architects, engineers, get it designed, permitted, and then we're going to bid it out
Mhm.
and get ourselves the lowest bidder. Those with maybe a little bit more experience, they know that the lowest bidder is never good. So
Mhm.
they choose the next lowest bidder. But the problem is that this approach, they're trying to save cost on design and engineering. And it's very easy to save a lot of money on design and engineering. You just don't design half the stuff because you don't need it for the permit. The city's
Mm.
going to give you the permit, but your set of documents is still 75% full, and there's a lot of questions. And if those questions aren't on paper, then you're opening yourself up for a number of change orders. And you can't even have your contract to guarantee everybody's loving this guaranteed maximum price contract.
Mhm.
The problem with guaranteed maximum price contract is it's based on the set of documents that you've given the contractor.
Mhm.
And if all of a sudden you start working and there's, I don't know, an entry canopy that was not detailed, and the drawings just said, "Oh, there's gonna be a canopy." And the contractor said, "I don't know, we'll throw $1,000 in the canopy." And then you get to build in it, and the contractor says, "What exactly do you want it to look like?" You're like, "I don't know." And then you call up the architect or send him an RFI, request for information. So what is that canopy actually going to look like? The architect says, "Oh, I had this beautiful vision." And they draw up this detail, and the contractor says, "Okay, we can do that. That's going to take us another 3 weeks, and it's going to cost us $50,000 because we didn't anticipate this and that. Those materials are out of stock. This needs to be custom fabricated." And you're like, "Holy crap, you guys gave me the guaranteed maximum price." They're like, "Yeah, based on a canopy, so we throw an allowance, but we didn't anticipate all of that. That wasn't in the plans. Here's a change order." And so things like that happen all the time. And knowing that, having that experience, we sit and comb through all of the documents. And usually it's super important to have the contractor involved very early on so that they could take literally every sheet of drawings, sit down in a room with the architect or engineers, in fact, and ask those questions and figure out what is that material. If the material is not specified, because a lot of times they just draw a line and there's no information. How do you actually make it? How do you install it? How do you fabricate it? And a lot of times the designer would say, "I don't care how you install it." And then the contractor says, "If I use this method, it's going to cost this much and it's going to take this long. But if I use that method, it's going to be different. Do you care?" And I, as an owner, might say, "Yeah, just do whatever least expensive." And the
Yeah.
architect might be like, "Oh, no, you can't do this one. Yes, it's cheaper, but this is going to be so much better for whatever reason." So those are the type of things that are extremely important. And when there's that collaboration and when there's that communication, that's how you avoid unhealthy conflict.
Mhm.
But it is extremely important to have that healthy conversation of finding the balance of maybe you tell the architect, "Look, I love this idea, it's brilliant, but it doesn't make financial sense. Can
Mhm.
you come up with something similar that would be less expensive?" And that's when their creative brain starts working. They're like, "Okay, I could probably live with an alternative design."
Yeah, the creative problem solving. I think one of the biggest issues that we had on our biggest development project was that we were looking for a financial partner from the commercial contractor. Because as we were talking to contractors to come and bid the job for us, they were like, "Well, we would like to invest in this. We'd like to be your partner on this." And so as we're waiting to see who's going to bite, are they actually going to follow through? We just had to keep designing the product because we couldn't get a contractor on board early on with that financial partnership commitment. And so what we ended up with was not a design build. The contractor that actually ended up coming in and financially supporting the project and building it, they were like, "Why is this architectural so expensive?" And our architect was like, "Well, because we're doing all the engineering, we're doing everything. Like, this is not a design build project. This is not like fill in the blanks. This is like down to the centimeter accurate because we've been waiting for you to like, decide that you want to do this project." And so they said it was the most complete set of plans they'd ever started with, which to me, I was like proud of that. Right. And they're like, "No, that's not actually positive." Like having a little bit more leeway to be able to make those decisions as problems come up, it actually would have been easier to deal with a design build. I know what's your opinion on that as far as controlling costs through knowing everything beforehand versus being able to be creative, in mid-project.
So I like knowing everything beforehand.
Mhm,
But to your contractor's defense, if they participated in that design process from the beginning, they would get the same level of completeness, but they would get something that is actually making more sense to
mhm,
build in terms of cost. Because using that same example of the canopy, if they ask the question early on, what is the canopy looking like? And they discuss different approaches to building it. And then the architect designed something that makes financial sense and that contractor already bought off. Then it wouldn't reduce the complexity of the plan set because all of those details are still going to be described in there. But it would be the process, the design process that would be considering all of the aspects of the design as opposed to if the contractor comes in later and you just tell the architect, "Give me all the details to down to the last screw that goes in there." They'll do that. They'll draw it up. The engineers will calculate it, and it's going to be perfect. And the contract, and that's how a lot of government jobs are done,
Mm,
right? Because they don't care how much stuff costs, right? They just design it, and then
sadly,
they can always raise taxes to finance it. So
print
they
more
get all
money.
these details, right? And then the contractor comes in, and they're like, "Okay, great. Now we know exactly how to build it." Does it make financial sense? Maybe not, but the question is answered. So I personally like knowing exactly what those details are ahead of time, because I want to make sure that my contractor calculates them, because I hate being surprised. And I would personally prefer to pay a lot more upfront than paying that in the field.
So, how detailed do your plans get before you start a project? Because what I've learned from development, my inexperience, the first attempts at development versus, what we eventually started working on, the experience matters in development more than just about any other type of project that I've ever done because there's so many details and unknowns like, "Oh, the geotech report hasn't come back, but the neighbors had to put pilings in their foundation." Or we got one back where the water table was too high and we had to put a membrane in the underground parking that we hadn't planned on. Like those types of things because the geotech engineer was like, "You're probably gonna need to waterproof this structure." That just because he had waterproofed the one that he built down the street. I realized, wow, there's just so much stuff that we don't know that the experience really pays here. So at a certain point, your experience pays off, but you know how much detail you want and how much you wanna leave in there. So what's your sweet spot?
Definitely work with the team that has done similar product in a similar location. That would help tremendously. But at the same time, let's say you don't have a geotech engineer that has done a project next door. Another set of geotech report is going to be, I don't know, $10,000, $15,000. Let's just say $20,000. If you're working on a $50 million job, it's a drop in a bucket. So I would rather do that and know exactly what we're dealing with, and then have my soil engineers design it, have my structural engineers design it. Yes, I might pay a little bit more upfront, but I would prefer knowing that. I'll give you
Mhm.
an example. A few years ago, we were working on this townhouse development right here in Bellevue, and we had the geotech, and the geotech engineer tells me that these soils are okay if you build in the summer. It's you got good soils, but it's this crap that as soon as it gets wet, it turns into jello, and it literally just it doesn't hold anything. Your concrete would sink right through it. And I'm like, okay, that's cool. We get our permit in, I want to say, August. We get a financing confirmed in October. I got construction team ready to go. I got my financing paperwork, loan, construction loan ready to sign. And I'm like, screw it, let's just go. We'll figure it out. It's not raining today, so let's just go. We're in Seattle area, right?
Not
That year,
raining?
that was
When does that happen?
it was that weird week when we were celebrating that we got our permit and financing,
Time.
and it was sunny.
Yeah.
We started construction. I think it was October or November of 2015 or 2016, and it was the wettest winter on record in the history of the state. It ended up costing
Of
us, I
course.
don't know, at least $500,000 more, and set us back at least 9 months. So
Would it have
I wish somebody came in and said, Stop this insanity. Wait 6 months and you'll be fine."
I hear real estate investors, whether they're developers or flippers, they'll be saying things like, "Dude, you gotta hire some help. You gotta get a crew in there to do it because you'll have like your weekend warrior, one man handyman show who's trying to do this flip to rent it out on his own." And he runs the numbers and he said, "Well, I got bids from 3 contractors and it's gonna cost me $25,000 to have them come in and do it. But this place only rents out for $1,600 a month. So how many months of vacancy can I support doing it myself and still come out cheaper than what they're charging me?" And so sometimes people are not looking at those things. It's like what you just said, if you just waited 6 months, instead you waited 9 months, right? It's like,
Right.
how long could you stand the project to be sitting idle before you say it would actually be more expensive if we went this
Right.
other route and take longer if we went this other route. And so sometimes that's where the experience really shines to be able to say, "Hey, we're going to make this decision process because of something that happened to us in the past and we learned from it."
Sure. And keep in mind, development is also part science, part art, right?
Or
Yes, financially speaking, it would have made more sense. My motivation was partially I owned the construction company.
Mhm.
I had all these people on payroll,
Mm,
and I was like, do I keep paying them their monthly paycheck and have them do nothing? Do I pick up some side gigs to keep them busy? Or should we just keep going and we'll figure it out? And I
yeah,
said, let's just keep going. We'll figure it out. We figured it out at a
yeah.
cost. So it's hard to know. Would I have done it again? No.
Mm,
I would have said either let them go or try to find them another side gig, something keep them busy, maybe find some small remodel to do that winter so that
mhm.
they're mostly indoors. I don't know.
Well, it's just those things. They fall how they fall, and we learn from them. And the longer we do this, then things change. I think sometimes you get on the opposite end of that where you've been doing this. Let's take your dad, for example. You've been doing this for so long. They're like, this is the way it's done, son. And you're like, that's not the way we do it anymore. So at a certain point, staying nimble and staying flexible goes back to that conflict that you were talking about before, having
Right.
that healthy discussion with people who are open to being wrong maybe, or being taught.
Right.
Very, very important. And to bring this kind of back to an investor standpoint, for the listener, you did mention something about not having the network early on when you were working in finance to be able to figure out how to go get new jobs and how to go find what you needed because you didn't have the people that you needed. So how does that openness to learning and growing, learning from your experiences, also being open to not getting too entrenched in the way you do things, kind of impact the investor who might wanna come into a project a little bit more on the passive side?
Yeah, so it's funny because our niche is partnering with owners
Mm,
to help them develop. We recognize two camps of owners.
mhm.
One camp is people think, "Oh, it's easy. I'm just going to hire some people. They're going to design it. I'm going to get a permit. Then I'm going to hire a contractor. And 3 years from now or 2 years from now, we'll have a finished project. This is how much it's going to cost. The contractor is going to tell me what it's going to cost to build. I'm going to hire the cheapest contractor, and I'm going to go shop for the cheapest loan, and it's going to be easy." And look, all these people around me across the street, there's all these developments happening. I've seen it done before. I can do it. And then this other camp that says, oh my God, this is like rocket science. It's basically equivalent to landing a man on the moon. I don't want to touch that. And it's usually somewhere in the middle, right? We tell people, look, it's complex. It's a lot of managing different personalities, different trades, different professionals, municipalities, and figuring out finance, marketing, legal. It's basically all of these different trades. You have to know a little bit of each one of them to be able to navigate it. Do it inactively, it's not impossible, but I would say do some research, at least be around a project, participate in one project full cycle from the beginning to the end to see what's happening. And when we partner with owners, we say, if you want to be active, if you actually want to learn, let's do it together. Sit in the office with me, participate in every meeting, have your input. Obviously, it's your property, have your input, but let us guide you. Let us do this first project together where you could learn. If you feel like you're comfortable enough to do it actively on your own next time, by all means, just keep in mind it's a full time job.
It
And
is.
so, so if somebody is doing something else, like if they're a doctor, if they're a software engineer, if they're a lawyer, probably have a full time job already, and doing a development on the side, even if they decide to build a little vacation house and they think that they can do it on their own, it's a full time freaking job. So if you want to have two jobs, fine, but you have to be prepared for that. Now, the other group that says, "Oh no, that's too much. I will invest passively." What I want to do is let them understand the risks. Look, it's not so risky that you're probably going to fail. No, but you need to realize where the risks are. So, if you're investing in a development project before the building is designed, before the building is permitted, your biggest risks are: what if you're never going to get the permit? What if there are other issues like it's happening a lot in our areas, the NIMBYs, not in my backyard. The neighbors start suing you because they don't want you to build something.
Mhm.
That happened to us, delayed us by a couple of years once. That's a risk. Your money's potentially going to get tied up. The economy is going to change. The design permitting process, depending on the project. If it's a house, probably 6 months. If it's an apartment building, could easily take 2 years around here. And so those are the things that you can influence, but you can't really control. And so that's where the risk lies. Construction, there's a ton of construction risks out there. Hell, somebody could fall out of the window and die, and then your job's going to get shut down by police investigators, insurance companies until they figure out what happened. Those things happen. Those things are preventable. And so if you're working with a contractor with good safety record, with safety staff, sets of checks and balances, you're minimizing those risks. If you invest in a project when the permit's already issued and the contractor has already reviewed the project and you know that it's an experienced contractor, you know that they've been involved in the project for some time to know the plans, all of those things minimize the risk. And when we work with passive investors, everybody likes in real estate likes quoting their IRR projections. I personally don't like IRRs because development projects, unless we got the permit, we got the financing, we're starting construction, it's really hard to actually predict how long it's going to take. It might
Yeah.
take 3 years, it might take five. And that time influences the IRR. So I prefer focusing on just return on investment, your equity multiples, things like that. And our benchmark is usually double your investment. I figure if we could double investment for our owners or for our LPs, then we're successful. It's risk reward. When you're buying an existing property, there's still risks out there, but it's more forecastable.
Yeah.
If you've got ongoing operations, you've got your rent, you know what the rents are, what your expenses are, it's easier to forecast. With development, you have to forecast operations, but then you also have to forecast the construction. So the risk is higher. And if the risks are higher, you're expecting higher returns. So it's really what it is. Is it for everybody? No. But as long as you're comfortable with knowing that there are more risks and willing to accept those risks for higher returns, then yes, I think it should be a portion of anybody's portfolio.
I agreed, and I like how you phrase that. It is definitely more risky, but it pays a lot better, and I find that some of our investors tend to one side or the other. Like you said, they're either like, "Oh, I'm gonna make so much more on the equity in this particular construction project or heavy value add," and then they forget about the boring stuff that provides cash flow. Like, what we do now mostly is private debt, which has
Mhm.
a much lower rate of return, but it's first lien and it just kind of rinse and repeat like clockwork. We got into the point of our own passive income journey where we needed to think more about reliable cash flow and we're not
Mhm.
chasing yield. But then we have some people in our debt fund who are so risk averse that they're not taking opportunities to invest in some things that might pay them better. So
Right.
there are levels here. Like for the passive investor, you have to have a foundational level. Do you have a job? Maybe you don't need the reliable income, but do you want your entire portfolio in high risk stuff? Or do you want your entire portfolio in super safe, boring stuff? You just, what is it? Pro tip, spoiler alert. Like you don't want your entire portfolio in anything. And so just
Right.
having a nice cross section of what's out there. Real estate is very easy to diversify. There's so many different ways. Like I could diversify by building an apartment building where we are now in Salt Lake City and then building another one with you in Seattle. I mean, even that is geographic diversification. I could do one where I'm the active manager and one where I'm just a passive investor. That's another way to diversify across my time. So it's you can diversify across returns, across risk profiles, locations, operators, all sorts of things, even
Right.
inside of real estate and then diversifying outside of real estate as well. So I really liked how you brought that up. It should be a part of most people's portfolio to the extent that they can absorb that risk depending on their age,
Right.
how much they have invested, their time horizon, all of that. So I appreciate you bringing that up because I think a lot of people, they really want to go all in to the safe thing or all in to the risky thing. And it's really important to spread that out.
Yeah, diversification, asset allocation, time horizon. I used to have Series 7 license.
Yeah, there you go.
We practice a lot of that. But yeah, it's funny because a couple years ago, interest started rising and we completed some of our projects. We were fundraising for our future projects. And we're like, should we maybe diversify and start acquiring existing operations? And then we made a conscious decision that no, let's focus on development, even if it means that we're not building anything right now. Let's focus on development because that's what we're known for. And rather than us offering diversification to our investors, I would much rather them have a choice of who to invest with to be known that we only do new construction, we only do new development. That's our profile. The only diversification, if you will, that we have is we might have apartment buildings versus townhomes versus maybe a hospitality project. But we try to focus. I don't want to touch industrial. I don't want to touch office just because I don't know those markets.
Mhm.
I don't know those industries that well.
Yeah, it makes it harder to predict, like what you were saying. There's a lot of stuff you have to predict, a lot of details,
Right.
and you have enough details that are 1% off, adds up to a big difference. So the more
Like
details there are, the harder it is to predict.
exactly,
Yeah.
exactly.
Well, let me have you tell us how your structure works. So take us from the first time you contact a potential partner, landowner. I know that's what you spend a lot of time networking on LinkedIn and your socials to get that network so that you can get those projects under. So you meet a landowner, the process that you go through to find out the project, and then even a little bit from the legal standpoint. Like if somebody was to reach out to you after the show and said, "Hey, Eugene, I've got a piece of land in an area where you might be developing. Let's have a conversation." Kind of walk them through on this show what that agreement, partnership agreement looks like and carry us through from the day you meet to the day the project is completed.
Yeah, I love that question. That's what we do all the time. It's really an iterative process. And a lot of times I get calls from owners when they already started development and they may have already designed a house or a building and started going down the permitting road and realized they don't know how to fundraise, don't know how to get it financed. And so they call us to partner with us, which we love to work with those owners as well. My favorite kind is when somebody calls us, says, "Hey, I've got this piece of land. I know that everybody around me is building apartments or everybody around me is building these duplexes or triplexes. And I think I could do that. Help me out." First step is usually feasibility study.
Mhm.
And what we do, again, if it's something that we've already done in this particular area, we can just say, look, here's what the numbers look like. We've already done this. In most cases, it requires a little bit of research. So we would do cursory code research, land use code to see what's allowed. We would sketch out what I call a back of the napkin pro
Mhm.
forma, where ballpark, okay, based on the square footage, based on the size of the building that we could build, maybe we could put so many units. I think they rent for around this much. I think the construction cost is going to be about this much per square foot. So it's very high level back of the napkin pro forma. If that makes sense for the owner, then the next step would be to figure out how we're going to get it financed. And typically, there's a value, obviously, to this land. What we say is their contribution to this joint venture is their land. So, if there's a simple example, if there's no debt, we get an appraisal, we know what it's worth, and that would be the value of their contribution. Our contribution at the time when we first get started is zero because we haven't invested anything, we haven't done anything yet.
Okay.
And then typically, the way we work is our direct expense, our overhead, gets paid for by the project. And then we never make profit on the development fee, on development overhead. Our profit is always back ended. So that becomes our equity contribution
Okay.
into project. And then we start the fundraising process. A lot of times owners would say, I've got this much cash that I could potentially invest to get this done. If they want to retain full control or if they want to own 100% of the development, we're fine with that.
Mhm.
We could work as just a fee developer,
Okay.
even though it's not our preferred method. We prefer to put our development profit in equity. And so that we had vested interest, and most owners recognize that way we also have our skin in the game. So we don't
Mhm.
just get fees. And so the next step then is to finance the development portion of the project. The easiest way to do that is to borrow against the land. Now, there's obviously risks involved in timing because you need to know how long it's going to take to get the building designed and permitted. But typically, with some cushion, that's usually the easiest and the fastest way to finance the early stages of development. During that stage, as the architects and engineers and the contractors are working on putting together the building, then we focus our time on fundraising for the actual vertical construction. And so that's when we put our PPMs and start marketing this investment opportunity
Mhm.
so that passive investors, when they come in, typically, in my experience, passive investors, because of all those risks that we discussed before, they don't like investing this early on. They prefer investing when the project is already formulated and we know exactly what it's going to cost and how long it's going to take. So, our goal is to start fundraising and have our equity ready to be deployed when construction starts.
Mhm.
And so, our first big effort is marketing and promoting the equity fund for the project. And then, parallel to that, we work with lenders to finance the debt side of the equation.
Okay.
And again, depending on the project, there's multiple avenues for debt. There's conventional commercial banks, there's private debt funds. There's preferred private debt funds that do regular construction debt, but then they do what they call senior stretch debt. So they give you a little bit more money for a higher price. So it works like a preferred equity, but they still take your land as collateral. And depending on the size of the project, that could take a couple of years. So hopefully by the time we get the permits, we get our building design costs fully estimated, equity raised, and debt ready to be signed and deployed, and then we start construction.
Okay, so early upfront costs that are incurred before the construction loan funds. You said that could either be by the owner themselves. Could you fund that as portion of your equity if the owner doesn't have enough money to do it, or will you raise from a few trusted investors to fund those upfront costs, or all of the above?
All of the above. Yeah, we have invested our own equity early on. We haven't done it in the last few years just because we want to focus specifically on building our development sort of network and do as many projects as we can. And we're building our portfolio of equity investors. So, yes, we could open it up to equity, to LP investors, and we would typically structure them as a separate class of equity. Those folks that are investing earlier
Mm.
versus those who are investing later. Like the project we're working on right now, it's in fundraising, but we have a pool, a what we call a GP pool, a general partnership, but it's not technically a GP. It's just what we describe it as. But the GP pool, it's about 10% of the total cost of the project.
Mhm.
It still has a lot of investors, LP investors, but they are investing into the GP pool.
Mm.
Then we have the second, what we call an LP pool, that's reserved for the vertical construction investors. And they are typically larger check sizes. We're targeting bigger family offices or institutional investors. We're hoping that somebody would come in. So, like for this $100 million project we're working on, rather than working with a bunch of smaller LPs that would throw in between 20 and 100,000,
Mhm.
we're targeting $5 to $10 million check sizes
Okay.
for the LP side. But
Mhm.
on the GP side, we have LPs that invested 50, 100,000, 200,000.
Okay. Okay, so you can kinda take on both because there's oftentimes a big difference between raising, say, less than $20 million. It's really retail investors to fund those kinds of projects, and anything more than yeah, it's certainly more than 10, but definitely more than 20. You really do have to be in the institutional, space, so you can get family offices or opportunity zone funds or whoever it is that is a
Right.
little bit more institutional. So how do you separate is it just one PPM so that you could have a retail investor or an institutional investor in the same fund? They could just pick which class of share they want based on how much they put in or when they come in?
The reality is, if you knew ahead of time how you're going to structure it and what's going to happen, you would write one PPM and you would have one operating agreement and you would describe all your different classes of
Mhm.
investors. But the reality is, when you start, you usually don't know how it's going to end. You create one operating agreement, one PPM, and then when you get to the next phase, you create another PPM, and then you modify your operating agreement or you rewrite your original operating agreement. That's what's happening with our big project right now. And we're working with another group that's more on the fundraising side, folks with Empower Investing. So they're managing this retail syndication fund where I focus more on the development side.
Mhm.
We've done it in-house ourselves on smaller projects. So it almost feels like a lot of times we're reinventing the wheel a little bit, but it's because you change one variable and you no longer can use the same formula. You have to
Mm,
adjust the entire formula.
yeah. Well, no 2 projects are alike, especially when you're building from scratch. Even if it's the same
Right.
floor plan, the same house, it's
Exactly.
a couple miles away and maybe different city, different permitting, different
Market environment changes. We started this job 2 years ago when interest rates weren't as high and there was plenty of debt available. There was plenty of investors available. All of a sudden, interest rates shoot up. We're like, okay, let's regroup. Let's maybe put it on pause a little bit. So
yeah.
we waited about a year, slowly fundraising. And now we're reactivating this work again, hoping to start construction the spring of 2025. So because the market environment changed, interest rates changed, supply and demand changed, we now have to rework a lot of the same documents that we work with.
Mhm. Okay, yeah,
Even investors that were committed early on want to get out and new investors want to come in. There's all these things are shifting and evolving all the time.
okay. So as a passive investor, maybe understand that there might be a revision that you need to sign or things might evolve as the market or the timing or the economy or the things just don't expect it to be one and done. Because I have heard people who are raising capital say, I'm not ready to take money yet because I'm not sure if this project is going to make, and I don't want to have to send money
Right.
back to my investor." And another capital raiser said, "I send money back to my investors all the time. They like that I say, 'Hey, this project ended up being a dud. It didn't work out for
Right.
whatever reason. Look, I'm protecting your money. Here, have it back. Let's bring it on the next project.'" So sometimes the limited partner can be spooked, especially retail, spooked or a little skittish if anything changes. So in development, you got to be ready for things to be a little bit more fluid.
You definitely have to be prepared for changes, be comfortable with potential changes, and know what your recourse is. So if you're sensitive to something like that, I don't know, put a provision there that if something material changes, you get your money back. Or what we do a lot of times is before the project is fully funded, the money sits in escrow.
Mm,
So you know that unless we raise whatever the minimum that we committed to raise, it's going to sit in escrow. It's going to earn whatever minimum interest rate there. But if it doesn't happen, then you're going to get your money back.
yeah,
If something has to change, let's say we raised 90% of the funds and then a big institutional investor comes in and has their
100% of the
and
equity or something.
and then we could or we might have to issue them a separate class of shares.
Mm,
Yes, we're gonna have to do that. We're gonna have to make that change, and we're gonna have to disclose it and communicate to everybody. And if somebody's uncomfortable with that change, they should be able to get their money back.
okay.
So as long as everything is communicated and transparent, there's obviously a lot of security laws that
Yeah.
go into that, and that's a whole separate subject conversation. But
Yeah.
my approach is as long as we're transparent and as long as the investor understands that there may be changes, especially with development, especially if you're an early stage investor. If you're a seed investor into a startup, definitely don't invest the money that you cannot afford to lose.
I phrase that
Things could
sometimes as
happen.
your business plan didn't read the business plan. And
Right.
you just never know sometimes what's gonna happen. So, yeah, very interesting and just being a little bit more nimble and on our development projects with our investors, like, we didn't have any retail investors in, like, the biggest one we've ever done, and it was very different working with an institutional investor than a retail because they weren't holding us to anything. A retail might be like, "Well, this is what you said at the beginning,
Right.
and that's not how this is panning out." So, on that one, I found that the institutional investors were different in the sense that how much input control, like you said, wacky requests, things like that. What have you found the biggest differences are working with an institutional versus, say, a retail investor? Not only working with them, but attracting the capital in the first place.
So with institutional, you almost have to be the way I describe it is with retail investors, you have to present to them the deal. This is
Mhm.
what I'm offering. These are my terms. This is the package. With institutional, they don't care about your package because they're going to have their own
Yeah.
package, their own formula. If they like the project, if they like the people, if they like the location, they're going to tell you what terms they need.
Mhm.
Here's what we need, and then you're going to take their terms and see if it makes sense for you. And that's what I was saying. If we syndicated the deal with mostly retail, and then an institutional came in, they're not going to care about our terms. They literally will not even look at them
Yeah.
because they have their own prescriptive terms. Because they usually have a big committee that decides these, and they're like, "This is what we're going to do. This is our box. Either you're going to fit into that box or not." And pitching to institutional, I typically don't even worry about spelling out. We never send them a PPM or anything like that, a subscription agreement. I don't care about that because they're going to come back and say, "Here's what we need." Right. Well, and the thing is, the hardest part dealing with institutional investors is you have to give them a financial model
Mhm.
and you have to guess what terms they would like. So a lot of
Mhm.
times, what we would do is we would have our initial pitch, we would send them like a one pager, and then we would try to extract from them what are the key parameters. What does your waterfall typically look like? What cap rates are you underwriting to? Because if I'm underwriting to one cap rate and they're underwriting to another cap rate, I want to present to them what they like to see. And in 90% of cases, they take our model. We send them our Excel model at
Mhm.
that point
Yeah.
because I know that they're going to break apart our numbers and put it in their underwriting model and
Mhm.
come back with some sort of a decision or terms that they like.
Yeah. Kind of an apples to apples. I've noticed it's tough sometimes when you have a creative deal structure on the institutional side because they get so many deals in that if they don't really get what's going on here, it looks a little different. Because institutional becomes more rinse and repeat the bigger the check sizes get. I don't know if you've noticed the same thing. They're like, I don't know. They just check it. We have plenty of other deals to choose from.
Absolutely. It's very hard to get their interest. That's why we try not to send them big pitch decks
Mhm.
just because they don't have enough patience.
Yeah.
I try to have a conversation, a quick phone conversation. What are
Right.
you looking for? What are the deal sizes? What are the regions? And if I can tweak my deal to fit their parameters, then I would pitch it to them. If
Okay.
not, so we're moving on.
Okay.
because
Yeah.
I know they're busy, we're busy, and I don't want to be the guy that sends them 20 deals a month. We don't have that many deals. But
Yeah. Definitely they have, like an ideal deal that they do. It's almost like an ideal client or an avatar.
right.
And then they don't step outside of that very often. And believe me, when they do, the ones that were stepping out of their ideal in order to consider what we had, boy, they made us pay for it. Not with money,
Right.
but just with like how appreciative we should be that they were going to look at a check size this small or a project in this city or where whatever it was.
Mhm.
They were stepping
Right.
outside their box. They made a big deal out of it. So, yeah, definitely interesting for the retail investor kind of understanding how this stuff works, how they might be able to get into it. I know like you said, you spend a lot of time networking both for partnerships with owners, with lenders, with retail investors, with institutional investors. Before we wrap up, tell me, where do you spend most of your time? What's your specialty inside of this specialty?
In the last couple years, I've been more on the marketing side of things
Mhm.
and business development side of things.
Okay.
Normally, I like to think of myself and describe myself as like this numbers geek. I like being in financial models. I like looking at projections. I like reviewing those weekly, monthly financial reports to see where we're at. And that's where I'm historically used to be.
Mhm.
But in the last couple of years, because we haven't been actively building much in this economy, I've been more on this business development marketing side, which actually is a lot of fun for me. I enjoy doing these podcasts. I enjoy our social media activity, and that's bringing a different flavor to our business and to our structure. So yeah, networking, meeting with owners, meeting with a lot of recently, especially a lot of financial institutions, and seeing what they're doing, what they're not doing. Yeah, that's where the time goes.
Yeah, I agree. When money is easy to raise, I spend more time on deal finding and financial modeling. And when money's hard to raise, I'm a marketer. No,
Exactly.
I'm definitely a marketer right now. Yeah, it's been, definitely very different, but investor confidence, I can start to see, like, the winds starting to shift a little bit after the holidays are over, after the election is over. People after an election tend to be a little bit more, positive for investor confidence anyway, so we're starting to kinda see that now, and I think it's just gonna get better as springtime kinda comes around, but I don't know. That's what I'm telling
We'll
myself. If
see.
I didn't believe that, it's been a rough probably almost 2 years, rough 2 years with just trying to figure out a downturn, but this is the badge that we all wear, like, if you started before 2008, everybody's like, "Oh, I've been through the downturn," right? Well, this is kinda the downturn right now, and, we're all getting a lot of experience, and people who survive this are the ones that you wanna do business with,
Right,
so
exactly. Yeah, it's like a downturn that will never end or never start. I don't even know. It's
it's
weird. Like,
weird.
I expected a recession and then it never happened.
Yeah, it's like the phantom recession, and we're all like, "Is this it? Or are we still waiting for the black swan shoe to drop?" Like, I'm not really
Right.
quite sure what's going on. Every
Yeah,
recession is kind of weird, usually by what causes it, you didn't see it coming. But this one is weird because we don't even know if it is one.
exactly. I don't know. I disagree with Fed lowering interest rates, even though it helps us, but I think they're doing it too early. I almost wish that we just crashed and burned for a little bit and then we could recover. But
Yeah.
now I don't know what's going to be happening.
I feel like they're getting better at smoothing out the volatility, and I'm hoping that's what's going on and not what Turkey, like, "Let's lower interest rates until the economy explodes." I'm like, "You know that doesn't work, right?" So I agree with you. I'm a little concerned. I feel like we're in a very inflationary environment for several reasons, from construction, onshoring, demographics, lots of
Right.
reasons where it's gonna be inflationary for quite some time, and they lowered rates. I was like, "What? What are you doing? Like,
Yeah, I
inflation's
know.
not over yet." So we'll see, but this is one of my favorite topics. Like I said, I could geek out on it forever. But let's wrap up by asking about Eugene's passive income plans. Like we at a certain point in our lives realize like we love what we do and we want to keep doing it, but we also don't want to have to need to keep doing it from a financial standpoint. We want to need it for personal fulfillment. So tell me about your own a personal financial journey into passive income and what work optional looks like for you personally.
I think I'm still in this I'm still in the long-term investing kind of mode. I refuse to admit that I'm aging, even though I just got my reading glasses. And so I still thinking that personally I have another 20 years of growth. So my strategy is still long-term growth, even though I'm becoming more cognizant of trying to build this income producing portfolio
Mhm.
to get off the hamster wheel of continually chasing new deals. and working on new deals. Development could get stressful and it just could get old. After a little while of dealing with all of the different forces, you're like, the hell with that. I'm done. So yeah, I'm looking at so it's funny, every time we develop an apartment building, we say we're going to develop it and we're going to hold it for at least 10 years. We're going to refinance it, get all the LPs paid off, and this is going to be our long-term hold, and maybe we'll pass it on to the next generation.
They
Single
don't
building
want
right
it.
now.
Trust me, my kids are like, "Don't let me inherit any of your buildings."
Right,
Like, just teach me how to buy my own and we'll call it even. So, I love that because on the one hand, I don't wanna work either. I just love lazy afternoons and going wherever I want and taking the kids to do fun stuff. And then there are other times that I am so hungry for what we were doing, and
right,
it's all I can think about, all I can do, and you can't really turn it on and off like a light switch. That's the part that I struggle with, is just
right.
being able to say, "I love what I do. I'll probably work till I'm 75." But I also love being able to say, "I'm not gonna do that today. I'm gonna take my kids ice skating."
Yeah, it definitely business itself takes time to ramp up and wind
Mhm.
down, but it's this flexibility that I personally love
Yeah.
is, yeah, you don't have to do it. You do it because it's fun. And even with the podcast that I'm running, at some point, I would like to bring a host that would be working for the company and doing it for us. I'd love to be featured there, but I don't want to be the one doing it every day.
Oh, I would just do this. Like, if I could just host a podcast, that's all I would do.
Just talk to people every day.
Pretty much. It's like there have been a couple times when I'm getting ready to do a podcast that I'll be like, "Oh, I gotta stop what I'm doing and go get ready for a podcast." And I think, "Why am I thinking that?" Like, that's my favorite thing to do. I just have a hard time a little
Right.
bit sometimes shifting gears, but I would shift gears into a podcast. I should have 5 podcasts and just literally do this all day. Yeah. Well, tell us about your podcast. What kind of person should be listening to your podcast, and how can my listeners get in touch with you after the show airs?
Absolutely. My podcast is called Real Estate Development Land to Legacy, and I talk about real estate development. The idea was to try to educate owners about development, about what it
Mhm.
takes, and if they want to listen to me and do it on their own. So I found that there's not a lot of information about development. There's a ton of real estate podcasts, right? There's a ton of
Yeah.
information for like architects or engineers or
Mhm.
contractors, but there isn't a lot that talks specifically about real estate development. So
It's the hard part.
that's what I wanted to focus on. And other than that, I'm giscompanies.co. That's our website. The podcast page is giscompanies.co/podcast, where the links to Spotify and Apple and YouTube and all those other platforms. And yeah, I'm on all social media, LinkedIn. Look me up, connect with me. I accept pretty much everybody. Even if you're trying to sell me something, I'll
Yeah.
accept you.
You back. That's
Right.
how LinkedIn works.
Other than that, Instagram, TikTok, Facebook, YouTube, EG_developer is my handle. And
Nice.
yeah, feel free to follow. I'd love to get in touch.
Yeah, I've been loving your content lately. Because I'm not doing development right now, I feel like I'm living a little bit vicariously watching
Thank
what
you.
people are going on. So I appreciate you taking the time to come on the show with us. Encourage the listeners to go check out your podcast, especially if they're interested in development as they have a project that they want to do, or even if they want to be a passive investor. It's really important that we get information from people in our network because not only do they not teach this stuff in college, they don't even teach it in most real estate coaching courses. I
Right.
tried to find it on YouTube when I started like 6, 7 years ago, and I found one guy giving a TEDx talk who said development's the only job where you work for 3 years hoping you get paid at the end of it, and that was basically his development education for me. It's like there's just not
Right.
that much out there. So I appreciate you putting the information where people like me, the weekend warrior developer, or people who wanna be completely passive can go and get great information, or people who wanna partner up. So appreciate you coming on.
Excellent. Yeah. Thank you. Thank you so much for having me, Emma. It's been a pleasure. I love our conversation. I didn't even notice how the time went by.
Yeah. Appreciate that. If you wanna get in touch with
Yes.
me, investwithemma.com, and you can come to our free commercial real estate meeting that we have every Monday night where we just look at deals and we crunch the financial models and see if we want to invest in them. So it's a great way to learn about commercial real estate. We do some development, we do some apartments, we do some of all sorts of things. And so if you wanna really dive into commercial real estate, I would love to have you on Monday nights, and that's at riseclubcapital.com. All right, until next time.